Jeff Lewis, Head of Investment Services with JP Morgan Asset Management, joins us live from Hong Kong. Jeff, good to have you back on ET Now. Thank you for joining us. Jeff, last week, all the economic data which came for the U.S. economy was constructive. First, it was ISM's job report, then it was auto sales data, and the big one on Saturday, which is the U.S. unemployment number.
Yes, that is correct. We've been saying for some time that once the effects of fiscal drag start to fade, then as we go into the end of the year, we will see more clearly that the U.S. economic recovery is broadening out and strengthening. And I think we're beginning to see that in the data now. As you say, the majority of the indicators were positive, particularly, of course, the jobs data. When you factor in the revisions to prior months, we're now tracking over 200,000 increase in the non-farm payrolls as the trend. And that could well be the factor which persuades the Fed to start tapering off QE3, maybe as early as September.
Jeff, besides commodities, you think the ongoing turmoil in Egypt could have repercussion on equities as well?
Well, I think what is going on in Egypt is specific to that country, although what we have seen is that there have been protests for various reasons in a number of emerging markets. Egypt is not particularly large as an emerging market, but then Brazil, Turkey obviously are. So these factors haven't really helped. It hasn't helped sentiment towards the asset class. I don't think it's been perhaps a reminder to investors that political risk is higher in the emerging market space. At the same time, when that's come on top of relatively disappointing economic data, it's hard to see any near-term catalyst, even though valuations are now looking pretty cheap, more or less across the board in the emerging markets universe.
Jeff, one side US Fed is looking at tightening, but if I look at the comments which have come from ECB and Bank of England, other central banks are maintaining that it is too early for them to increase interest rates and they want to continue with their accommodative monetary policy. So given the way what you've heard from Fed and what other central bankers could do, what does that mean for global liquidity?
Well, I think we're not going to see a global liquidity crunch. The ECB, the Bank of England, they're quite clear there that it is too early, and we agree with that. Their economies are a couple of years behind the U.S. in terms of recovery. They're behind the U.S. in terms of getting on top of the problems of the financial system and the banks in particular. So they need to stay very accommodative. The Bank of Japan is turning the taps on, and it's committed to doing that for the next 2 years. So there's still going to be a very accommodative global liquidity background, which is going to be supportive of markets. I think that's being forgotten in all the attention that's been focused on tapering. Tapering, after all, is also not tightening, as the Fed has reminded us last week. It's only starting to be less aggressive in supplying liquidity. So I don't think we're going to see the banks make a mistake of withdrawing liquidity when economies are still relatively fragile, except for the U.S., of course.
Jeff, in general, are you constructive on equities? Most of the major developed markets are sitting at a multi-year high, and with growth making a comeback, historically I've always seen that equity as an asset class, it tends to outperform.
At this stage of the cycle, yes, we are constructive on equities, on particularly U.S. equities. And we have been recommending being overweight that asset class, focusing on higher quality and also on the dividends yield paying stocks for some time. So you're not going to go back to a situation like we've had in the last couple of years where you've had double-digit returns from the fixed income markets. That era is over, and investors are going to have to go up the risk scale now if they want to achieve those double-digit returns. They're going to have to take on equity risk. That is the place to be.
Jeff, good chatting with you. Appreciate you taking the time out and speaking with us today on ET Now.